We think this is an excellent time to invest in high quality bonds. We're yielding now 6.5% to 7% on high quality fixed income investments. And we see several catalysts for lower yields over the next several years. So these yields now provide potential equity-like returns with a third to half the volatility of equities. And with growth slowing and inflation peaking and coming down, we think the central banks are near the end of the rate hiking cycle. So investors today can lock in these yields, which we haven't seen in 15 years.
As Mark mentioned, it's a quite attractive time to be adding to high quality fixed income. We saw a glimpse of that during March of this year when equities declined post SVB, but fixed income did quite well as yields came down.
We are finding opportunities across many sectors of high quality fixed income asset classes. And I'll start with the credit corporate side. So just in the corporate side, we are seeing slower growth, but we still expect nominal growth of roughly 4 to 5%. This should still generate positive earnings growth. In fact, many companies are actually using this excess cash flow now to delever their balance sheet. So for example, we continue to like companies like airlines, lodging, gaming companies, aerospace. And also we've been moving into defensive sectors recently, like hospitals, pharmaceutical companies, as well as towers and telecom. These companies still generate very strong cash flow, even in a lower growth environment. And most of these companies are still paying down debt. So what's really important about this is that while the government market technicals have turned negative lately with higher deficit spending, less foreign buying, we're seeing the opposite in the corporate bond market. These higher yields are actually attracting more demand from insurance and pension funds. At the same time, we think companies will issue less bonds at these significantly higher yields, which we haven't seen in 15 years. So that is also a further catalyst for investors to want to add to high quality corporate bonds.
Yeah, I think as Mark mentioned, I think in addition to kind of the travel theme, we have been steadily moving into more defensive areas of credit markets, given where we are at this point in the cycle. I think one other area where we've been shifting to a defensive stand is through agency mortgages. Agency mortgage-backed securities underperformed as the Fed started its quantitative tightening last year. They underperformed further post Silicon Valley Bank as FDIC reduced agency mortgages, and then other banks have been on the sidelines. So when we look at the valuations there, they are the widest they have been in 15 years. In addition to kind of the agency mortgages, we are also seeing opportunities outside of US. We are seeing growth divergence between US and other countries. We are seeing inflation divergence. So that is creating opportunities across regions, that is creating opportunities across sectors, as well as individual companies. So for us, we think it's an attractive, very attractive time to be actively managing high quality fixed income, like high quality investment grade credit portfolios at this point. We are fortunate to have a large team of analysts as well as PMs to look for such opportunities and add value for our clients.